Hello, ladies and gentlemen. The risk dial finishes the week at 28 with, surprise, surprise, actually, the daily model in risk on, the monthly model in risk on, but the weekly model still in risk off. If we have a look at what happened, we have the moving average at minus 1.24. So it has not crossed over as yet, but I think that is purely mathematical. Unless something incredible happens next week, it'll cross next week. This is very odd behavior, but there you have it. We are oscillating, and I think as long as we stay positive and we don't break 28.64 on a closing basis, next week we should be in full risk on. If we look at the databases, the deviations, we will see that what the market has done is actually quite simply come off the very overbought levels, and now it has supported the central line, which is 28.64. Funnily enough, only if we break that center line will we go all the way down towards 2800 and lower. But if we don't do that, we have room to slowly edge our way back towards the close of last Friday, which is around 2950. I would encourage you, as always, to have a look at the various components and see how well they bounce from one edge to the other. There are certainly some very good investment opportunities and trades for you in this environment. The one that I am actually most worried about is here, XLK, and I'll actually enlarge it. This one probably has some more room, probably a new low to make before it starts going up and taking out these highs, but I think it's going to take a long time, and that is why I think that the upside for the time being is capped to where we were last Friday. I want to start this week just by showing you what the forward earnings have done against the market. I said last week that I expected this kind of action, crawling up the just below the times 17 Blue Angel. And this is exactly what we got this week. The move lower. If next week we go higher towards the times 17, stop everybody out who's short, come back down. That is what I expect, with that 28.64 level acting as a base on a closing level. If we close below 28.64, we could easily go to the times 16 Blue Angel. In fact, I think we definitely do, and that is around 2800. I know that this chart is now getting boring because it's just not moving, but believe me, one day it will, and that day will prove very exciting because we will have a major macro move in foreign exchange and also in equities as a result. I will later on discuss what is going on in the individual parts of the yield curve, but it is beginning to be very interesting. I've been for a while meditating on what is going to drive the stock markets a lot higher, and I have a possibility outlined. But that's not going to happen until this breaks. And let's now look at the individual parts of the yield curve. This is a chart that you haven't seen before. It's the 2-year note, the very short end that a lot of people disregard. Now we have this very important level here at about 218, 219 yield, where the market stopped, briefly corrected, and then went straight through to make new highs around 3%. Since then, we have been coming off steadily as people have discounted that the Fed is no longer going to raise rates. So now we are really in a range between 240 and this 218 level, which, if broken, is going to signify that the Fed is just about to ease rates. An easing of rates in the States would make the 2-year note go quite a lot lower. I mean, a lot lower. And I don't think it stops until it gets here, around the 145, 150 area. I have no idea if it's going to happen, but if it starts breaking this 218 level, and I have some 2-year notes on board, and I've had them for a while, simply because they have optionality. I think the worst that can happen is that we go back to this kind of level, the 240 level, and the best that can happen is a lot lower. I like being long of optionality, so I will stay long of 2-year notes. The Bund is completely dead. It has improved slightly. 8 is still the amazingly important swing level, and I'm going to hold all my positions, my current positions, against this 4 basis points level, 4.5, maybe 5. But certainly if it starts going through 8, that is a signal that we are going to have a major move in the Bund, to the downside in the Bund and upside in yields. I certainly think that it trades somewhere around the 19 to 20 area. That is going to be a very big move and have a major effect on 5 years and 10 years in the United States. This is the yield of the 5-year note, and I've told you that it's basically stuck between 220 and 240, and this is exactly what's happened all this week. Even the weakness in the stock market couldn't really prompt much of a move in the 2-year note, in the 5-year note, I'm sorry. It's basically stuck for the foreseeable future. The Fed has sent this market to sleep. You can safely ignore 5s and 10s for the time being and really concentrate on 2s. I'm not saying the 2s will move, but we have our level. We have 217 to 18, and if that starts moving, this will move too, but much slower than the 2-year note. Much the same picture as in the 5 years you have in the 10 years. Basically, 245, 240 on the downside, around 260 on the upside. A 20 basis point range. This is a trading market. As I've said before, the Fed has sent these markets to sleep. So only if the Bund makes a major move will we see a shadow of a move here in the 10 years. Going back to what I said, if we do have a break here in the I expect this break now to become on the upside, simply because the dollar is not doing what it should be doing, and it's quite obvious that Trump, through his tariff policies, wants to control the dollar and probably get a lower dollar. So we have another possibility of breaking this 245 level, and that would mean actually that the 10-year note in the States does nothing while the Bund starts going up. And we should be very aware of that possibility and watch those yield levels that I've outlined in both contracts extremely closely. And here we have the dollar. Over the course of the past 5 trading days, it has done not much with this Trump tariffs talk. But I think it is indicative that it's not breaking to the upside. It had a very good opportunity here to just come back to this 97.50 level and then start going up. And this part is what I don't like, the fact that it just cannot hold this 97.87. I am very much in 2 minds, but I now have a strategy. And my strategy is simple. If we start breaking through the 50-day moving average, from which we bounce so nicely, and start going down towards 96.50, and the 200-day moving average, I'm going to buy straddles struck at 96.50. Simply because a market which doesn't go up when it should, tends to go down. And I will then double up on that position whenever the previous charts, i.e. the Bund 10-year note chart, gives a signal. That will really be a massive sign that Trump is achieving something that is going to be good for US manufacturing. I've always said that what he wants is to bring jobs back to the United States. He wants to bring back manufacturing jobs. I don't think that without a lower dollar he can achieve that. I didn't think he could achieve a lower dollar simply because of the yield differentials. But if he manages to convince the Fed to start easing, and that is where the talk of the 2-year note comes in, because if the 2-year note starts going, you can bet the Fed is going to ease. And in that case, you might see a complete debacle in the dollar. It might fall out of this range that it's been in for the past year. Let me just zoom out for you. You can see this this lovely channel that it's been in. If it breaks the 200-day moving average, breaks the 9650 level, and then breaks this trend line, we are definitely going to go to this kind of level, and that is at least 9360 and quite possibly 9250 in the very in double quick fashion. I'm not saying it's going to happen. I'm just saying that that is my doubt, and the 9650 area is a wonderful area to buy straddles, simply because it is the 200-day moving average. It is the most important swing level, and in macro terms it would make a lot of sense, because the weakness of the dollar would propel higher the equities. From a technical point of view, our friend the SPX did absolutely nothing wrong this week. It stopped everyone out above 2864 and closed straight back above. It left a few gaps on the daily chart. What I think is more likely to happen than not is that we slowly trade around the 2864 and do a cup and handle type formation, which launches us to above 3000. But let's have a look at that on the dailies. And here we are on the dailies. What a beautiful chart, how well it's hogged the moving average and closed within the Bollinger Bands. It's tried very hard to break down. It couldn't. Now I think any move above 2901, 2902 takes us straight back to 2913, 14. We close above there, and there really isn't anything until we close the gap around the 2950 area. It's odd, isn't it? But I do think that they're trying to engineer a higher equity market, a lower 2-year note, and possibly as a result a lower dollar. The one market which tempers my bullishness in ES is actually NQ. I've been really trading, jobbing NQ from the downside all week, and it has worked simply because it's just too overbought. The real supports, and we are talking about the equivalent of 2864 in the SPX, isn't until here, 7,208ish. In fact, I'm going to put a line in there. It might be slightly higher. What is it? 7,319. I wouldn't be surprised to see a divergence developing between NQ and SPX over the course of the next couple of weeks, simply because I think it would do NQ a lot of good to even touch these levels before launching higher and helping the S&P well over 3,000. I think the next couple of weeks we might see 1 or 2% divergence between NQ and SPX. I much prefer SPX from the long side and NQ for short shorts. Our friend the Russell let us down. Not its fault. I blame Mr. Trump. It broke back down, though it closed through all these previous highs the previous week, and now we are back within a range. I think we are more likely than not to trade sideways, to maybe make a small new high, but I think most of the impulsion from the Russell has now been lost. This is a very interesting chart of SPX again. We can see how we got right to the moving average on Friday and back within the channel that's held it for such a long time. We bounced around the bottom of the channel down to 28.64, came back down, took everybody out, did it a couple of times and launched back in. Really anything above 28.90 argues for a visit to around the 28.12, so it really does match up very well with the futures. Next week I expect much the same kind of behavior. This kind of 29.15 as a temporary top, and a couple more tests of 28.64 before we can start going higher. EEM, which I've told you to be very careful of, actually got taken to the cleaners, very close to getting filled at my level here at 41. I think this too has a very good chance of recovering over the course of the next few days, back up towards this 43.12 area. That would be an indication to me that the crisis is more or less past and that the SPX can trade above that 29.15 area and close the gap that it left from last weekend around the 29.50 area itself. The reason why I think 28.64 is not going to be broken on a closing basis next week is because this is a weekly chart of volatility. Volatility for the week closed lower than its open and right at this 16.10 area, which is so pivotal for it. We went all the way up towards the 23 area and got smacked right back down. To me, we are likely to maybe test 20-ish and then come right back and close these gaps. So I would have thought that 28.64 looking at volatility is unlikely to be broken on a closing basis, which tells me that the market is likely to actually next week close higher, well above 2900. If we look at volatility on a daily basis, this is a daily chart. Well, I think this is a bit of a failure. I think we could easily come back down towards the 14 area once maybe we've tested back higher towards this 17, 18, 19 area and then come back and fill the gap towards 14. That is what I would expect over the course of next week. Certainly the fact that we traded so much higher and we could never close below 28.64 tells me that any attempt back up towards this 1897 area is going to be a failure in trying to push it below 28.64, and that it's a buy at those levels for a move well above 2900. The DAX on Friday was a very good tell because it just couldn't even break the low of the previous day and closed right up at its highs. This is where it's going to open. It's going to open somewhere around here. This to me is a market which is going to range trade and probably trade right back up towards 12,350 before it has maybe another failure and then starts going again. This is not the kind of a market that has impulsion. If the DAX can't have impulsion with tariff talk and them being a very major exporter, and possibly tariffs coming onto German cars next, I really don't see how the US market is going to be is going to underperform that much and break 2864. I'm sorry, I just can't see it. This is a chart of the Dow, and we got very close to the 200-day moving average and put in an outside day up in the Dow. I think this is more likely than not to be continue to be very well supported here around the 25,400 level. Eventually, over the course of the next couple of weeks, as these indicators turn, we could easily see this kind of level, 26,300, something like that. And I would have thought that when the Dow is at those levels, the S&P will be closing its gap around the 2950 area. The one market which is weaker and does make me cautious is the transports. If we zoom in, the transports are, although they have not closed below the 200-day moving average, they did break it, and they have not put in an outside day up. They've just basically formed a doji. This market could easily go back up to 10,800 over the course of next week. But it's not a market with any impulsion at the moment. For it to show any impulsion, we would have to clear this kind of 10,900 level. And to me, this is a slight sign of caution that the rallies in the SPX are not going to be that huge for the time being. We are going to limit ourselves with an aim to closing the gap from last Friday. As to the biases for next week, well, no change in 5s and 10s. These are still to me the levels which won't move, but here I've put the 2-year note and that 217 yield level. Below that, and I think there's something afoot, the Fed is easing, closes below that, I mean, and that will certainly give us a steeper yield curve as people pile into the short end to take advantage. That to me will be another signal that we are probably embarking on a leg higher in equities. Equities do trade up as the Fed eases. It's only later if that they start giving up. It's a myth that that Fed easing isn't good for equities in the short term. Equities always perform by about 7 to 10% when the Fed starts easing, and it's only later, if we get a recession, that the equities are going to come back strongly. In the short term, they will definitely go up. To me, the Bund is all important, this 8 basis points level. And here is what I wrote last week. The important levels, 29.10, which is basically where it opened. We dropped below the 28.98 very quickly after that and got to 28.64, which never broke on a closing basis, and has seen some amazing reactions off it every time, at least 30 points in a couple of hours. So now I say 28.64 mustn't. The market mustn't close below it. If we do break below 28.64, I think the low that we made on Friday at 28.28 is not going to hold. I think we will be going all the way down to 2800 because we'll be in an outside week, 2800 or even lower, possibly even 2770, that kind of area. The only reason why I even have it as a possibility is because the transports are a bit problematic and because I don't like NQ at the moment. I don't like it compared to SPX, and this is what I wrote last week, and it gave it all up as quickly as it went up. And I don't like that kind of market. It means that the support is not really well defined. and this is what I've said. I smell something bad in NQ. It just trades wrong compared to ES. I will not be long of it overnight, and I will use it as my preferred shorting instrument. The RUT, well, it's a shame, but I think it's lost impulsion now, and I don't hold much hope for it going much above the current highs. It's a shame, but there you are. VIX, well, that got completely blown up by Trump on last Sunday. I now think it trades in a 13 to 19 range. It will be very interesting to see if VIX is around that 19 level where SPX is. I doubt SPX trades below 28.64 unless the VIX starts going well into the 20s. And here, this is what I've changed for the dollar. This, to me, is going to be the new level to get long of straddles in the DXY 96.50, because from that level it either breaks down, as I showed you, through the 200-day, through that very important swing level, in which case it's going to go 3, 4, 5%, and I expect that to be matched by moving the 2-year note. So here you are. These are my fears and expectations for next week. Thank you very much indeed, and tweet you on Monday.